All right, guys, welcome back to the third video in the intermediate section of this free course. All right. Today's topic is going to be about liquidity. All right. So just so you guys know, there's a lot of big terms thrown around and people like to make these fancy statements and, that they, sound important and, they know what they're talking about. I'm going to keep it real with you. I'm going to keep it real boring, lame, simple so that anybody can understand it. As you can see in previous videos, I don't I'll use the terminology so you understand the terminology that's used in the industry, but I'm going to break it down to you very simple, all right, so that anybody can understand it. Liquidity is nothing fancy. It is just money. That is it. That's all liquidity is, all right? So the first section we'll talk about, or the first type of liquidity we'll talk about is from previous highs and lows, all right? So let's say we have a bullish, all right, market structure. All right. Like I always tell you, some people are going to do what? Some people are going to buy, some people are going to sell. All right. Now, let's say that, we got this low here, price pushes up, makes a high. All right. It pulls back. You already know, makes a higher low. Pushes up, makes a higher high. And let's say now you're ready to get in the trade. You wait for a pullback, boom, pulls back to get a higher low in. You put your buy in right there. Price pushes up, you're in profit. Makes a what? Makes a higher high. All right. When you make a higher high, you're going to put your stop loss where? Below the higher low. Well, guess what? Remember, if we have that change of character where price breaks structure of the bullish market structure, it's doing that, all right, and it pushes down so that it can sweep liquidity. Anybody that had their stop loss here, that's liquidity, because now what? They take a loss, and the amount of money they lost now comes into the person's pockets that was selling right here. All right, because the person here did not close their trade, all right, and and their stop loss was triggered. All right. So that stop loss was money lost from one party transferred to the winning party that caught this sale. All right. So that's liquidity. All right. Price sold off there to get sweep liquidity. It pulled back and then continued to drop. All right. So that's how that works. All right. That is how that works from a liquidity standpoint. That is a what? From a previous highs and lows. That's a higher low there. All right. Higher low. All right. Another example would be, we'll show this on the chart as well. Another example would be, clean all this up over here. Another example would be the high and the low of, let's say, the day. So let's say, the day's moving, trending, boom, ends like this. All right, great. The low of the day is there. The high of the day is up here. Sometimes you see that, hey, when the next day starts, price will push up, take out the high of the day. All right, and then do what? Sell off and go take out the low of the day. All right, it's sweeping liquidity. All right, taking out liquidity, people that had stop losses or pending orders, because some people play or trade a breakout strategy. So another type of liquidity is not just a stop loss. So a stop loss is a type of liquidity, which is just money. Also pending orders, we'll call them POs, pending orders. So buy stops, sell stops, buy limits, sell limits. Those are what? Those are pending orders that would be above a high like that here, so that when price pushes up, it triggers those buy limits or buy stops. All right, doing what? Triggering somebody to get into a buy, and then it what? Sells off to what? Come down and take their stop loss out. Boom, they lose. Imagine having, hey, price closes up here for the day. You put in a buy pending order here. You put your stop loss down here. You trigger your, price pushes up to trigger your pending order. That's a buy. Moves up a little bit. You're in profit a little bit, and then it drops and it hits your stop loss. That is a liquidity sweep, and then price sold off to go grab your liquidity. All right. That's all it does. All right. Stop loss and pending orders. So in trading terms, a stop loss, pending orders like buy stop, sell stop, buy limit, sell limit. Those are the 5 types of liquidity when you're trading. They are nothing more than money. That is it. That is all it is. sessions. All right. So we talked about sessions before. We'll look at those as well. Let's look at New York session from 8 a.m. to 11 a.m. Well, imagine that, hey, this is New York session right here. New York session is here. This is New York session. Made a low right there, pushed up. And let's say New York session ends like that. And then after the session, price kind of moves up, pushes up, and then boom, drops. All right. It was trending low, had a pullback, swept liquidity from the top there. People will put their sales in. Let's say they put their sale in right here. They put their stop loss up here. Price shot up, took out their stop loss. Now they lost their money, and then price dropped. All right. So I'm teaching you and going to show you on the charts about where liquidity lies, because if you can understand where liquidity is, then guess what? You will be likely to understand where better to place your stop loss in the future when you put your trades on, so that your liquidity doesn't get stopped. Your trade doesn't get stopped out. All right. You're going to lose trades. It's going to happen. But the better that you understand about how liquidity and liquidity sweeps, liquidity grabs work, the better you will be at understanding when to enter a trade, where to enter a trade, and where to place your stop loss, so that you have the highest probability chance of what? Not being stopped out. All right. So fair value gaps is the last one we'll talk about. All right. Fair value gaps will be the last one we talk about. Their type of liquidity. All right. So if we have fair value gaps all on the way down, excuse my my drawings here, I'm not the best. But if we have all these fair value gaps all the way down, all right, like this here, so, and then finally this last candle down here, all right, gets closed above, and we have that what? We have that CSD, and then we wait for price to close down, come down, and then push up and reverse. Boom, it reversed, and it filled that fair value gap, it filled that fair value gap, it filled that fair value gap. These fair value gaps were liquidity that had to be filled. So price pushed straight through those fair value gaps to fill them, to bring balance to the market. All right. But they're all utilized as liquidity. All right. Sometimes, you know what I'm saying, we look for fair value gaps to come into and then continue to trend. But when they're filled like this, they are what I like to call liquidity fair value gaps. They're my favorite setups. I love them. All right. They help you to identify how far to take a trade. All right. They identify, of what price needs to do to balance the market, giving you a better understanding of what type of trade that you may need to take. All right. All right. So let's go look at these on the actual chart. All right. Go look at these on the actual chart. So we'll start out with previous highs and lows. So we talked about that previous high and low of day. All right. Let's look at it here. Man, you can see here, new day here. This is the start of this new day. And this is the end of this day right here. All right. And as you can see, price pushed up and took out the high of the previous day, and then sold down to take out the low of the previous day. All right. Somebody here, you see price sold down. Somebody had their stop loss up here. Price pushed all the way back up, took out the stop loss, and then sold down. All right. All right. This is why I'll be teaching you later on how to utilize the tools that I have available. All right. Because remember, that order block is the same chart. There was an order block right here and a breaker block. All right. You'll put your stop loss above that. All right. I'm sorry. Hold on. Let me erase all this real quick. I'm sorry. Wrong place. So we knew we had a order block right here and a breaker block right here. All right. And so when it comes to trading, what you want to do first is wait for price to go and sweep liquidity, make a market structure shift, then pull back for a retest for your entry. And we'll talk about this later on. We're going to put it all together, but you can see it all here. We swept liquidity from the previous day right there with the wick from the previous day. So that's the first step. Price then what? Sold down. All right. We talked about this in the previous video. It had a CSD, a change in the state of delivery. It also had a market structure shift or a change of character, created a bearish order block there. It also created a bearish breaker block there as well. We talked about that in the last video. Price came back to that same area to give you your entry for that sale. At that point, when it comes back for the entry here, Once you put your stop loss above the high of this order block or breaker block, you are now safe. Why? Because the liquidity was already swept there. Then we had the change in the state of delivery and the market structure shift that formed the breaker block and the order block that are both bearish. Then we had the retest of that bearish order block and that bearish breaker block. But because we already swept liquidity, we had no need to go higher, which means you can put your stop loss above that area so that it doesn't get swept, and you got a higher probability chance of price then going in your direction, the full move, to take out what? To take out the low of the previous day. Ta-da! All right. It seems and looks simple, but it takes patience, takes practice for it to be set, for you to get to the point where you're very confident and consistent at catching this type of setup. All right. So I just want to show you that's the high of a day, low to get the high of the day, and then a couple hours later to get the low of the day. What about a session? Here's the New York session, the 8 to 11 a.m. session. All right, 8 to 11 a.m. Central Standard Time. All right, you can see we moved up, moved down, moved up. All right, moved up. All right, session's over with. Price kind of moves down, pushes up to do what? Sweep the liquidity. This big sell-off, people putting sell their stop loss above this high. All right, price pushes up, takes out all those stop losses up there. Then it sells down to do what? To catch the sell, to take out the low of pre-market. The New York session. Swept the liquidity, then sold down. All right. So what do we want to do? Let's go clear all the drawings here. All right. We want to wait for liquidity to be swept like it did right there. We want to wait for the CSD and the market structure shift, which is made right there. Then it's going to have an order block right there. We want to wait for price to come back up to that order block. I'm sorry. So the sweep happened there. All right. Highest up close candle right here. Boom, boom, boom. Price came back to retest there. All right. But now it's a new day. So that's why you want to wait. All right. Because now it's a new day. So now there's another potential target to be swept, because now you got what? A big sell-off here. All right. That came from the high of the day, which has the potential to be swept. So it's why we don't look to take that trade until after we have the liquidity sweep. Then we get in there. And that's why that's a more successful trade than trying to catch it here at that order block, breaker block. All right. You want to wait to catch it at this order block, breaker block over here, because we swept the liquidity from the day. All right. Now, if you get in on a lower time frame, you probably could catch this liquidity sweep here, the change in the state of delivery, as well as the market structure shift, and there might be a pullback on a single candle. But right now, we're not worried about that. But you can see here what happened. You can see here what happened. Price swept liquidity from the high of New York session, and then from the high, and then it sold down to sweep the liquidity from the low, because somebody thought it as well as a buy. Price came down here and pushed up, and somebody had a buy order right here, stop loss down here. Price pushed up, then came back down, stopped them out. All right. So the highs and the lows of sessions are also liquidity as well. You can see here, New York's London session. There's the high there. There's the low. Price pushed up, took out the high. Next day, came down and took out the low. All right, that's how it works. Liquidity is always being swept at some given time. All right. Now, let's go back and look at the last thing, which is the fair value gaps. All right, let's go look at the fair value gaps. Let's go find some fair value gaps that we can actually understand about liquidity filling. All right. So we can see here that what? Once we swept the low of New York session right there, price then dramatically pushed back up. All right. And when it did, you can see it left the fair value gap there. And we talked about this on an earlier video. It left the fair value gap there. All right. It left a fair value gap, very small one in here. And then it left one as well here. And you see, after we swept liquidity from the high of the previous day, right here, price then sold off to fill all of these fair value gaps. Came down to the last one, pushed back up to come back to that order block and that breaker block so that I could what? Sell and continue its trend down to take the low of the previous day out. All right. Price swept liquidity, shot down to fill these gaps. Fair value gaps are also known as, what you'll hear me call them as, some others as well, inefficiencies, because it's inefficient price movement. You don't want price to go straight up. You don't want it to go straight down. All right. You want to have a circular motion, up and down, up and down. Whenever you have price going straight up like that and leaving these gaps, you should expect later on for price to reverse to come down and fill those gaps or fill these inefficiencies. But you most likely won't see that happen until price sweeps liquidity first, and then you'll see that it fill those gaps. All right. The market does two things. It fills inefficiencies and it sweeps liquidity. If you can identify the sweep of liquidity, most likely you're going to get a reversal or a continuation of price moving up to fill inefficiencies. In this case, we were moving up here, an uptrend. Price moved up aggressively here towards the end of the day. The next day, kind of just ranged, pushed up, swept liquidity from the previous day's high, and then sold down to fill the inefficiencies that were left at the end of the previous day. All right. Great, easy move to understand. All right. Allow you to catch trades and be confident about your trade and understanding where it's going to go. We'll talk more about that later on when we put everything together. Hope you found some value in this video. See you in the next one.